here's your standard deviation here. There's your standard deviation. Okay, we'll change it so that it makes it a wee bit more challenging, easy for you to understand. There's your standard deviation right there. The high price here is 500, and the low price here is 100. Okay, so you're just coming into tomorrow's market. So obviously the standard on this is 400. So how do you go about pricing this? How would you as a market maker price trading right now at the close? How would you price this? How would you go about pricing this market? What are the two most important things or three most important things that you're going to look at in terms of pricing this storyline? How would you price this, guys? Come on. How would you price it? When we have are interested in getting involved in a conversation. Because at the core, it's the most important thing, isn't it? At the core, this is one of the most important aspects of trading. So there's a couple of things. One, future events is obviously going to be the most important, right? Because I need to know if I'm going to price it the same as today or less than today or more today, right? So, so obviously if we've got a non-farm payrolls coming up tomorrow, if we've got a big release coming out tomorrow from the CPI, am I going to price it cheaper or more expensive? Going to be more expensive, right? So obviously we look at that and say, well, if it's positive or negative, that's probably the single most important question that I can ask at this point, because without any other information, everything else is kind of pointless. So obviously if there's a future event which is positive vol, give me an idea. Would you do a 400-point standard deviation? No, you'd maybe increase it to 600 points, right? So for argument's sake, you'd maybe increase it to 600 points. If it's negative today, you'd maybe say, well, 400 points, we'll maybe take it down to 350 points. But would you price it at 600 points if it's positive vol? Because obviously the key is that you still have to be competitive. So what if I priced it at 1,000 points? Would I be competitive in my offer to the marketplace if I priced it at 1,000 points? No. So for example, let's assume that market maker A is offering a call option in the product. For argument's sake, $50, right? So they're offering a call option on a product at $50. And obviously you're coming in with your offering because you've got 1,000-point standard deviation. You're coming in and saying, well, I'll offer you a product at $75. What call option is this person going to buy? They're not going to pay $75 for the same call option, are they? They're going to pay $50. So if I price this at 1,000 standard deviation, then of course that means that I'm never going to do any business. That's called hiding. I mean, that's how market makers sometimes hide. That's how you sometimes see, for example, interns, when they come into a desk, for example, they think they're busy, but their bid offer spread is so far out the market that they never trade. They're just hiding from the market, right? They're scared of getting involved, and it's a very bad trait for a market maker who hides from the marketplace and constantly just pulls bids and offers. Yeah, but I was in. You weren't in feck all. You never took a single trade. What are you talking about? You were in. Yeah, I put my bids and offers in. We just never get filled. Bullshit. Absolute rubbish, right? So you can hide from the market by putting your price at such a ridiculous level. You never get traded. And therefore, it still has to be competitive. So what we end up seeing is the most competitive quote, don't we? We see that balance point where this guy thinks, because I'm offering 75 and he's offering 50, this guy thinks, I might be a little bit too cheap, and this guy thinks I might be a little bit too expensive. And what happens is the price then meets in the middle, doesn't it? So maybe the price meets in the middle and it says, right, we'll offer 60, 59s, 58s, 60, 61, 69s, probably a little bit far. So you start recognizing that you start offering a competitive quote so you actually get business done. But obviously the second part to that is you don't offer standard you don't offer the standard, the standard opinion, the standard deviation if you don't think it's going to, if you think it's going to reach that point. So you kind of price it up a little bit more. So if you think the volatility is going to be 600 points, you're not going to offer 600 points. You're going to offer, for argument's sake, 650, aren't you? You're going to offer 650, and if it's the 350 one, again, you're not going to offer maybe 350. You're going to say, well, I'm going to do 400 again. I'm going to do 400 because it's still competitive, but I'm allowing myself the space. Now, what's the second piece of information? Somebody said it earlier. Second piece of information is the skew. So obviously, I need to know whether I'm going to start putting my offers more expensive or my bids more expensive. So that is called the skew. So when you look at this and we say, well, you know, we obviously have to build a scenario in this, and the scenario is perhaps it's the positive volatility. We recognize that the skew is good. We recognize that perhaps the skew is built by informed traders, which more important to us is that it's built by informed traders. So if I'm looking at this trade here at, for argument's sake, at a price of, what would that be, about 400. So I'm looking at this price here of about 400, and I'm looking at an implied volatility of 650 total points, 650 from swing low to swing low, from swing low to swing high, 650, 700, whatever. Then, of course, at 400, if I was to do a normal implied volatility, I would obviously do 300 above. So obviously, I would now be pricing this at 700 and 300 below, which means I'd be pricing this at 100, right? Can everybody agree that's what the flat volatility skew would look like? Flat volatility. So this would be a 700 bid, and this would be an offer at 100. So that's, what's the difference between those two numbers? 600, right? So the difference between those two numbers is 600, but that's not got any skew in it. So obviously, how much of a skew am I going to build into this? Obviously, then becomes the next question. So what I could do is I could say, well, you know what? I'm not going to do this because I think this is very, very, very biddable. So what I'm going to do is I'm going to provide you with a narrative here, which is going to be a price for argument's sake at, I'll just put it a wee bit higher. We'll put it in about there, and we'll make it 250, right? So I'll give you a price of 250 on that side. And obviously, if we're doing the same to the upside, we'll give a price on the sell side of 850. And that's what skew is, right? So we give a price of 850. And obviously what that means is if I look at an implied volatility curve based on that skew coming in, what does the implied volatility curve look like? If you were looking at your vol-to-vol strikes, what would the implied volatility curve look like? Bottom left to top right, bottom right to top left. Which one? It'd be bottom left to top right. Okay, so you'd look at a volatility curve now, and it'd look perhaps a little bit like this, wouldn't it? It'd look maybe a little bit like that. So your implied volatility curve would be like that. Would everybody agree with that, based on the pricing? I mean, it can look all different shapes. It could be a straight line as well. I mean, it doesn't have to be that type of shape, but it has to be that slope, of course. It has to be that slope. So you get the basic idea that whether it's that slope or whether it's a slope that looks more like that, it doesn't really make any difference. That's the slope that comes from the implied volatility story at that stage. So obviously, what does this mean? Well, this means that we have the ability to work out what we could be looking at here. And that's why when the market is selling off, you give yourself a wee bit more space in terms of the likes of your, because your build at the moment doesn't have your fixed rate areas don't have skew built into them. Because obviously we need a concrete way for you guys to be able to access what the skew is. Because obviously the skew is going to change where these levels are, but the starting level's there for you to work with. The starting level is the implied volatility of that price, not the skew of that price. So obviously when we build the skew in, of course, that starts to lean slightly more to one side rather than the other. But in a lot of cases, it can be pretty marginal. In most cases, it can be, in most cases, pretty marginal. So we don't spend a lot of time trying to solve that puzzle because it's not really financially beneficial by that much. But you can see it in a microstructure it is, but not in a macrostructure. So when we look at these ideas, we can see how the implied volatility is, where the implied volatility is. And that's why the price should never reach one standard deviation. It should never reach it inside of a normal session, because obviously the market maker needs to churn these prices. So what happens is that nearly always, and I talked about this morning, nearly always the price bounces off a half standard. So there's your half standard right there, right? So that was what we talked about this morning in London, was it not? We talked about this bounce off the half here. And we talked about the bounce on the half on the NASDAQ as well, didn't we? We talked about that bounce on the half right there. There's the half right there. We talked about this trade here. And of course, we talked about the sell coming back off the RGL, right? So we talked about the sells coming back in off the RGL. And on the basis that it's coming back in off the RGL, the target must be one standard deviation. It must be. Because if the target's not one standard deviation, it should never have sold off the RGL. It should have gone all the way back up to the half standard deviation at the top edge, correct? That's what skew is. That's what skew is. So obviously when you're looking at the skew, you can see that the skew is moving to the downside. And if you trade one standard here, and then it sells off of here, the skew is very much the case that you are now aiming for this guy down here. You've got to be aiming for this guy down here. So when the price makes its move, you're kind of aiming to try and take the price into that area, just the same way as in this skew here. When that goes offered, you're aiming for that price there, because the skew is telling you that that's probably too cheap from an estimate point of view, and it should probably be lower than that, actually. So once you recognize what the skew is, you can adjust your ideas and your thoughts about where the price might go to, and that allows you to make better trading decisions, isn't it? So recognizing that change is quite important. But at the present moment, at the cash open, you can see we should not trade this. We should possibly trade 76.20s. And you can see from the cash open, we've already just rejected this 580, which is the dealer's key level here. So when you see the dotted lines at half a standard, guys, those are the biggest levels for dealers' activity, because if they trade below that, they're hedging. They're not dealing, they're hedging. So dealers will defend this level and hedge below it because they've obviously priced it wrong. If you go through that half, you've priced it wrong. If they reject the half, you're in good shape for the rotation. And they rejected the half here on the Qs, they rejected the half here on the S&P, and we have got that rotation back through. And that's quite a nice outcome. At the same time as that was happening, of course, we could then do an analysis of what the big global call is on equities. We could do an analysis on that. We could try and figure out whether equities have a bullish story or a bearish story. We could look at the global macro picture of it, the four keys, the four macro keys environment, to see what we think of the four macro keys environment and try and come up with a decision. So, you know, we obviously knew that we were in a 32 sell trade until, of course, we weren't in a 32 sell trade until the very next candle came in. And what happened was the 2's 10 started to drop, didn't they? So the 2's 10 started to drop at the same time as the beta was starting to slow down a little bit. So the macro keys at the open started to change ever so slightly. So the 2's 10 starting to drop, and the keys, the beta line kind of starting to flatline. That's called an MPV rebirth trade, right? So we get what's called an MPV rebirth, which means compressed spring, buy growth discounts. So you're buying growth discounts into the cash open. Is that reasonable? Well, let's take a look. Let's take a look and see if you can agree with what is reasonable and what is not reasonable. So I would have classed this as an MPV rebirth trade. So this is it here. So this is it here. So you can see And this is an hourly chart, so it kind of runs the half hour before the cash open, half hour after the cash open. So it's not obviously that screamingly accurate, but it's good enough for what I use it for. So there's the candle I'm looking at right there. So it's a cash open candle, correct? We're looking at the right thing. So it's the cash open candle. The question I've got for you is a very simple question. Is the blue line dropping, yes or no? On this spinner candle. Is the blue line dropping, yes or no? So it's not a conversation for the extent of drop. It's just dropping, right? It's not something that anybody can say, no, it's not, it's rising. It isn't rising, it's bloody dropping. So we can say that the blue line is dropping. Can we say that the black line is dropping but slowing down? So if we look at the drop phase, we can see that the beta is starting to slow down. So it's dropping, and the flattening is obviously starting to drop. So it's starting to move. I don't know how fast it's going to start picking up, but you'd imagine it's going to start accelerating. So what is the narrative? It's an NPV rebirth, net present value rebirth. So that means that there's a compressed spring coming in. Buy the growth discounts, buy into the growth discounts, and try and take a swing off the bottom edges. And obviously into the cash open, it was a perfectly reasonable proposition to then say, you know what, let's go for it then, let's try it. And since then, what's happened? Well, you can see that the beta line's actually now gone positive in a flattening environment. And obviously that means that we're obviously going to be seeing the front end starting to potentially rip up. And obviously if we started to move into highs, it might start becoming a little bit challenging. But because of the size of this move, I think it's got a long way to go before it starts giving us a major problem. So obviously if this drops a lot faster, it could become a major problem. But at the moment, it's dropping manageably at the moment. So I don't think it's going to cause us any real problems. I kind of like this through to top edges at this point. I like this idea through towards this top edge up here, for example. So I don't think there's any chance of us getting jammed up in this at this point. So it's a good looking trade. I kind of liked it, and like Davy said, we had a lot of dealers' reasons to be long into this marketplace. So we had a lot of dealers' reasons to be long. Looking at the dealers' keys, we had the dealers' key on the S&P right below us. We had the two standard deviations. The one standard deviation and the half standard deviation already in play at the cash open. So I think it was a relatively easy play to rotate back away from there. And it was an easy play certainly in the S&P to rotate away from there as well. And this is the NPV rebirth we're talking about, that very big discount on the NASDAQ. And with a very, very, very big discount on the NASDAQ all the way down here, you can see it's way more discounted than the S&P. You think that these NPV rebirths are going to happen here? Of course they are. Of course they are. When the NASDAQ's massively overly discounted, that's when the NPV rebirth comes in. And we get a chance to buy that NPV rebirth up into swing highs. And it's turned out to be a brilliant little rotation from $290s to basically $490s for $4,000 per contract on the swing. So well done anybody that took full and total advantage of it. It was a nice trade. It was a very, very nice trade.